Netflix grew, widened margins, edged past its earnings target, and still got dumped after hours. Oh, and generative AI is now sitting inside the production workflow. It's July 16th, 2026. This is Earnings Unscripted, and we're on Netflix, ticker NFLX. Second quarter, the global streaming business that's now subscriptions, ads, live events, the lot. Revenue was about $12.56 billion, up 13% from a year ago, and almost exactly where management had forecast. Miro, good quarter, bad stock. What's the disconnect?
It's a solid operating quarter with a demanding audience, meaning investors. Diluted EPS was 80 cents, a hair above Netflix's own guide, and operating margin reached 33.4%. Revenue kept moving up sequentially, the margin improved, and the growth came from memberships, pricing, and ads. There's no obvious crack in the streaming engine.
Yet, the tape heard no obvious crack and threw the television out the window. How ugly was the reaction?
Regular trading was basically sleepy. Then the release hit. The stock dropped sharply after hours and kept drifting lower through the call. It already spent the quarter sliding, so this wasn't fresh optimism being gently revised. The market wanted a bigger surprise, and Netflix mostly delivered on its own promises.
Since we're reading meaning into a dramatic tape, what you're hearing is personal opinion, not financial advice.
The other thing, and this matters, is last quarter's Warner breakup fee. It made prior period earnings and cash flow look enormous. This quarter, the fee vanished from profit, then the tax bill tied to it hit cash. So EPS and free cash flow fell hard sequentially without the core business suddenly deteriorating.
Okay, so Warner paid them, and now Netflix is sort of giving part of it back.
Not back to Warner. To the authority. That's the missing piece. Netflix also spent heavily on buybacks, so the cash balance came down for separate reasons: taxes and capital return. One's a cleanup from the failed deal, the other's a deliberate choice.
Got it. The ghost of the merger is haunting the cash flow statement, not the viewing app.
Exactly. Geographically, Latin America had the clearest sequential momentum, while Asia Pacific was nearly flat. But the more interesting operational signals elsewhere. Netflix says it's used generative AI workflows on about 300 titles this year. On the documentary The American Experiment, the team created historical crowd material that otherwise might have been cut because traditional effects cost too much.
Okay, when you say use AI, I'm picturing a tool helping artists, not Netflix pressing a button and generating the documentary. Is that the right frame? And where does the actual savings show?
That's the right frame. On this documentary, people made the creative decisions, and the tools helped build visual elements, especially historical crowds, that would have been too expensive using older methods. Netflix doesn't disclose an AI savings line, so the benefit shows up inside production economics, either lower cost or footage that can now survive the budget meeting.
So it's not necessarily we made the same documentary cheaper. It could be we made a better documentary for roughly the same envelope.
Yes, though even that may be too broad. We know 17 minutes of Final Cut footage used these workflows. We don't know the economics of the whole production, only that those specific sequences became viable.
Right. I was making the leap from cheaper effects to a cheaper show, and that's not quite supported.
Exactly. For those sequences, management said the work was produced twice as fast and at half the cost of previous options. That's tangible. It's not the usual executive fog of AI will unlock creativity someday. It's already changing which shots get made and which get deleted.
And presumably which projects get approved eventually. But okay, there's an uncomfortable labor question sitting in the room wearing a very obvious hat.
There is. Ted Sarandos addressed it directly. Quote, "We believe it takes great artists to make something great, and AI is not changing that. Movies are being made by people who make movies." That's the official line, and I think the documentary example mostly supports it. Artists used a cheaper tool to execute an idea, but the long-term labor impact isn't answered by one project.
No, because the artist remains doesn't tell you how many artists remain or how their work changes.
Correct. And I don't want to invent a headcount conclusion Netflix didn't provide. What we can say is that the cost boundary moved. A sequence that previously would have hit the cutting room floor made it into the finished film.
That's exciting creatively and, yes, threatening economically if you're selling the more expensive production method.
Netflix has always been ruthless about measuring what content earns its keep. Is AI basically another efficiency tool in that machine?
Partly, but the deeper change is what they're measuring. Netflix is actively arguing that raw watch time isn't the best proxy for business value. Greg Peters said, all hours don't provide the same kind of value to the business. A really great example of this is live programming. They do not yield typically as many raw view hours.
Okay, walk me through that, because fewer viewing hours still sounds like weaker engagement.
That's the incomplete version. Live events consume about 5% of content spend, but produce only around 1% of view hours. If hours were the whole scoreboard, live would look dreadful.
A beautifully lit bonfire for the content budget.
Except those events generated 6 of Netflix's top 10 single-day sign-up results across the period management examined. So a live baseball game may be short, but it creates urgency. People join now, watch together, talk about it now. An old kids series can run in the background all afternoon and generate many hours without causing anyone to subscribe.
So there's consumption and then there's catalytic consumption. One fills time, the other changes behavior.
That's better. And it explains why Netflix is publishing its What We Watched report less frequently, moving from twice yearly to annual. Management wants investors focused on revenue and operating profit, not treating every hour as interchangeable.
I understand the logic, but reducing disclosure while declaring the old metric less useful is awfully convenient.
Very. They may be completely right about the metric and still benefit from revealing less. Those aren't mutually exclusive. We also didn't get concrete subscriber additions, global average revenue per membership, or direct ad tier user counts here. So Netflix is saying, in effect, judge the economic output, not every gear inside the machine.
If watch hours aren't the scoreboard anymore and Netflix is showing investors fewer gears, what evidence should investors demand that this higher value content strategy is actually working?
I demand outcomes they can't redefine away. Durable revenue, stable margins as content spending rises, and better ad tier economics. For live, show that a sign-up burst becomes subscribers who stay. Otherwise, higher value hours is a clever theory with selective evidence.
So the test isn't whether baseball creates a big night. It's whether those new viewers are still paying later.
Exactly. If Netflix won't disclose that cohort data, investors will infer it from the financial output. Next quarter, management expects about $12.86 billion in revenue and a 33.2% operating margin. Growth continues, but margins soften in touch.
Which sounds controlled, not spectacular. After that stock reaction, though, controlled may not buy much patience.
No, the market's saying prove the newer engines are additive. Ads should roughly double this year, but we still don't know the precise revenue gap between ad tier and standard members. Narrowing is encouraging, it's not visibility.
And the revived free trials feel like another tell. Smart acquisition tool or evidence the easy households are gone?
Probably some of both. Testing outside the US and UK isn't panic. I'd watch conversion and retention. If those viewers stick, Netflix found another door into mature markets.
Then there's TF1 in France. That partnership feels like a prototype for becoming the interface, not just another tile.
Yes, and that's the strategic upside. Netflix can package local television, live moments, ads, and originals without buying the whole industry. The risk is complexity. More formats mean more ways to spend intelligently and more ways not to.
So I'm cautiously positive. The engine's healthy, the ambitions make sense, but fewer gauges mean every miss feels louder.
That's fair. Confidence now has to be earned through consistency.
Very Netflix ending. Keep watching, but check the bill. Thanks for listening, everyone. Bye.
See you next time.
If this kind of earnings chat fits your week, you might want to keep the show in your podcast feed. And for transparency, Miro and I are AI hosts. This conversation was written by AI, our voices are synthetic, and the Netflix call became an episode the same day. Thoughts and ticker requests are always welcome at earningsunscripted@data-madness.ca. Take care, and we'll catch you after another call.